Stocks clock small gains ahead of the weekend. Oil marketers, metals and realty are top gainers, while healthcare and auto are the weak spots. Midcaps fare better.
Well, gold hits another high, as does cocoa. Copper prices in Shanghai rise to their highest. Zinc hits a year high and tin at a 15-month high. Other commodities too clock gains in a broad-based rally. Metal stocks rise in tandem.
Indigo rises on expectations of higher summer fares amid tight supply in protein. eGov gains on the back of a bulk deal by sale of shares by funds. But Sun Pharma Advanced Research slips on its drug failing efficacy test to treat Parkinson's. IRB Infra skids another after an arbitration award goes against it.
Amidst the growing water scarcity in urban centres across the country, experts tell CNBC-TV18 that desalination, recycling and a mix of geography-specific and policy measures can help solve the problem.
Good afternoon. It's a good afternoon for the markets. I'm Manglam Malu. With me, Sonia Shenoy. A 0.25% gain on the frontline indices should not have you too worried, because we've seen a big record-setting rally for all the indices. It's the broader markets which will make your portfolios feel a lot better today. The Midcap index, another record high, up nearly 450 points a percent. Even though the broader markets, the breadth of the market is split right down the middle, 1,111 stocks advancing for the same number of stocks which are declining. The gainers are a lot more in proportion and in volume as well. Most of the gainers are clocking in 3, 4, 5, some even 6 and 7% gains. While the losses are limited to just about 1 or 2%, Sonia.
Absolutely. And, it's turning out to be a really good market, not just for the equities, but for commodities, for gold, for metals, right?
Cocoa.
Metals.
I was very excited about cocoa prices being extremely high. Excited because chocolate is an exciting thing. But
you have to pay more for it eventually.
Pay more for it, which also means that you
Did you just realize that?
Well, what can I say?
all our addictions are going to get a little more expensive.
Yes.
All our vices are going to get a little more expensive. But well, in any case, the markets are doing well, so the bulls are enjoying that for now. But let's begin the day by telling you about some stocks. In our Insight Edge segment, the focus today is on IRB Infra. The arbitral tribunal has ruled against the company in the NHAI case. Also, toll collection has jumped 30% to almost 481 crores in March. Vivek joins in to tell us more on that. Vivek, over to you.
That's right. So earlier today we had highlighted just prior to market open about how the company had gone ahead and given an update to the exchanges regarding one particular arbitration case that the company had against the NHAI. Now, this particular case was the IRB AV tolling case, which is the IRB Ahmedabad Vadodara Super Express Tollway. Now, the company had gone ahead and approached the arbitral tribunal, stating that there was a competing expressway, that had actually gone ahead and impeded toll collections for IRB's own project. And the company had gone ahead and asked for claims of over 1,032 crore. So this particular case has been going on for quite some time. Yesterday, the arbitration tribunal actually gave a judgment. However, this is a setback to IRB Infra. The company, the arbitration tribunal has said that IRB Infra will not be receiving this particular claim. So on the back of that, remember, analysts, especially CLSA, had written a note stating that even if 50% of the arbitration claims do come in, will be seen as quite a significant positive for IRB Infra. On the back of that, a setback coming in for IRB Infra. We spoke to the management. You also alluded to the fact that toll collections were quite robust in FY24, 30% jump just for the month of March 2024, and almost 24% jump for the entire FY24 toll collections. And they say that FY25 will be even better because they have a couple of assets coming in on way. So it's very strong toll collections, but a setback coming in terms of the arbitration tribunal judgment. However, the company will go ahead and also see whether there is any case for them to go ahead and take it to the higher courts and have this particular judgment reversed. On the back of that, stocks cooled off a little bit, but the stock has been a stellar outperformer the last couple of weeks.
That goes, Vivek. Earlier today, we spoke with Tushar Kevadia, who is the CFO of the company, to discuss this case in detail. Let's hear out what he had to say and also on the prospects of the business going ahead.
We have got the arbitral award yesterday only, and we were also being saddened with the award. So looking to the award, if you see, our claim was with respect to the competing facility to the particular stretch, and which was the claim was filed for from the year 2015-16 when we have seen this competing facility has come up parallel to our stretch. 1,032 crores, which was since 2015-16, which was filed as a claim in our in the arbitration claim itself, and which was for a particular period. Now this is a continuous claim which will be for a year-on-year basis. Confidence of our investors, which include the strategic investor like Sintra, that continued, and we have seen this deal happening at the private InvIT level where they are acquiring the stake from GIC of 24%, and with the valuation what they are paying, there's a price is 67 billion for the acquisition of 24%. What we have seen, the valuation, just doing the maths, it's like for the 10 assets which were part of which were operational, it was almost 2.5 times to the book, and with that kind of valuation or the fair deal, we see that the total valuation considering all assets would be somewhere around 400 to 480 billion.
All right, well, let's talk about some stocks now. Bharti Airtel, Vodafone and Indus Towers are all in focus on the back of commentary coming in from brokerages. Rima joins in to tell us more on that. Rima, over to you.
Thanks so much for that. So let me start with Antique on Bharti Airtel, where they believe that Bharti is set to ride its best financial performance in over a decade, which is why they've initiated coverage with a buy, a target price of 1,505. This best financial performance that Antique is referring to is driven by tariff hikes, upgradation of their 2G subscribers, strong growth in enterprise, FTTH, and a fall in capex once the 5G, because the 5G rollout has been completed. They expect the return ratios to top 20%, and the historic high cash flows will aid in deleveraging. On Vodafone Idea, CLSA has a sell call with a target price of 5 rupees. Vodafone Idea has seen a subscriber loss of 17 million in the last 12 months, and this is on account of low capex spend. The street is awaiting their external fundraise of $2.5 billion and the 5G rollout. And remember, today Vodafone Idea share price is also in the F&O band. And finally, on Indus Towers, Jefferies has an underperformed rating on the stock because they're saying after a 60% year-to-date rally in the share price of Indus Towers, all the potential benefit, all the good news is probably priced in. What is the good news for Indus Towers? That Vodafone Idea emerges stronger, they raise that capital, they start their 5G rollout, which means more business for Indus Towers, they repay their receivables. But according to Jefferies, all that is probably priced in after this 60% up move. So their target price is actually way down to 250 rupees. Back to you.
All right, Rima, thanks a lot for that. So that's about the chemicals, rather the telecom space. But I was speaking about the chemical space. All of them are buzzing around. Before we slip into a short break, just pull up the intraday charts of Navin Fluorine, up around 6% at the high point of trade. Gimmick company is SRF. That's the other one which is to move to the high point of trade. And we've already seen a big run in Tata Chemicals, and that continues as well. So it's a 3% up move that we're seeing on Tata Chemicals, Navin Fluorine, SRF doing well. And from the broader markets, we have a bunch of other stocks, Aarti, etc., doing extremely well too. So what we'll do is take a short break, come back and focus on a lot of individual stocks and the markets on the whole. But as we do that, here's an announcement that we have to share with all of you. We're launching CNBC-TV18's first ever live personal finance webinar. It's called CNBC-TV18 Accelerate Personal Finance Handbook with Sonia Shenoy, where she will be joined by 3 well-known experts on Saturday, 11th May, 9 a.m. onwards. We'll be diving into everything you need to know about mastering your finances, be it growing your wealth, insurance, tax saving, managing your portfolio, retirement planning. Lots to learn and lots to do. Whether you're in your 20s, 30s, or even 40s, this live webinar is for you. We have limited seats, so don't miss this chance. Register now. Scan the QR code on your screen, register, or log on to cnbc-tv18.com. We'll see you on the 11th of May. Welcome back. UPL from the frontline end also doing extremely well, up at the high point of trade. Not particularly a Nifty stock was, rejigged in the last, the announcement that came in. But the stock has been doing well ever since. But one of the stocks in the broader market is doing well since yesterday, our PB Fintech, higher in trade this morning, following on the gains that it saw yesterday post Policy Bazaar's partnership with ICICI Lombard. Yash joins in with more details on that story. Yash, the stock continues to rally.
Well, that's correct, Mangalam. So last 15 minutes of yesterday's trading session, the stock pulled up about 15 bucks from that particular point of announcement. And today that rally continues in the morning. It was up about 6% in trade. Now, the move that has come as far as PB Fintech is concerned is primarily based on two important triggers. One which came just during the market close yesterday and the other one which followed late in the evening. The first one is with respect to an agreement between ICICI Lombard and PB Fintech. Now, PB Fintech is the largest insurance aggregator. ICICI Lombard is the largest private general insurance company. And so far, there was no synergy between these two large players, which is set to change with that agreement. All ICICI Lombard products, be it motor, health, travel, home, business coverage, will be available on Policy Bazaar. Now, an important part is that all these products will be available both on the online business of Policy Bazaar, that is policybazaar.com, as well as the offline business, which is Policy Bazaar platforms. The reason why I say a very large player comes on Policy Bazaar, because ICICI Lombard has almost a 9% market share when it comes to general insurance company, collected about 25,000 crore in terms of premium in FY23. So, of course, this augurs very well for Policy Bazaar in terms of the income or the premium which it generates for ICICI Lombard also, as well as the revenue which it derives out of that, assuming 25,000 crore annual premium which ICICI Lombard, collected. Apart from that, the second trigger was incorporation of a new subsidiary, that is PB Pay. That will be a payment aggregator subsidiary. Now, of course, the market's been looking for new ideas in terms of new revenue streams which PB Fintech would look to add, and this is another addition as far as that new income stream or new revenue stream is concerned. This new subsidiary under payment aggregation business has been incorporated under PB Fintech. Now, this subsidiary will apply for a license from RBI, and once that license is received, payment aggregation business under this subsidiary, which will fall under PB Fintech, would be initiated.
Okay, thanks a lot for that, Yash. Well, just want to mention that the mid-cap end of trade is really on fire right now. Not only has the mid-cap index hit a record high, but it's almost a 500-point rally that we're seeing on the mid-cap index, and very, very strong up move coming into several stocks. I mean, Zomato, for example, is sitting at a fresh high. That one has hit a new milestone today, so fresh record high on Zomato. Lots of stocks in the metal space, Vedanta, SAIL, Nalco, all sitting at fresh highs. Hindustan Zinc, fresh 52-week high there. ICICI Bank from the heavyweights is also at a fresh 52-week high. This is turning out to be a really strong market. It's
a very strong market. If you needed any confirmation of the fact that we're in a bull run, this is it. Even as the mid-cap index, the broader, the frontline index is consolidating, we have a big move that we're seeing on the mid-cap index as well. A big move is what we're seeing in a lot of these other names, the chemical names that we spoke about, Paradeep Phosphates, surging. Granules India from the pharmaceutical space at the high point of trade. SBI Card was in the red for most part of today's trading session, has moved higher. And Atul Limited is the one which is up 5% as well. It is, the mutual fund data that would be released today, and we do have some initial numbers that have come by for, the previous month. And this month is also when we get the impact of the stress test. So what is it that we need to watch out for when that data is released later in today's session, close to around 1:30 to 2 p.m. Surbhi joins in with the key trends to watch. Surbhi, what is one to see?
Well, this will be the month when we get the impact of those much talked about, much hyped stress tests. Remember all the noise that was taking place about making investors steer away a bit from small cap funds and mid cap funds towards large cap funds. Now, is that really showing up in the data? That is what we need to watch out for, because there was a bit of a downward tilt to the money coming into small cap funds. Even in February, the number had come down to less than 3,000 crores, just around 2,900 crores in February. So let's see if that trend continues. And the flow towards large caps, the first signs of that were evident in January and then continued in February. The February large cap number was around 900 crores. So let's see if that build up, that whole narrative that the MF industry is trying to push, saying, we must diversify, must de-risk and put some money in large caps. Let's see if that's really working with investors or not. So that's number one. Number two, we have to see if the NFO party is still on. The previous month, February, was massive for new fund offerings. The total number of NFOs was 20 across debt, equity, passive funds all put together. and the total mop-up was a whopping 11,400 crores plus. Now, equity, it hasn't been all about big-ticket, large headline-grabbing NFOs in March. But a lot of fund houses have been filling in their product gaps, coming out with a small NFO offerings. So let's see what the total mop-up is like. And last but not the least, the trend for FY24 has been the rise of the hybrid mutual fund category. Remember, ever since debt taxation rules changed, debt MF taxation rules, that is, the industry has been pushing hybrid products, multi-asset funds, etc., in a big way. And that's where numbers have been very strong. 18,000 crores, over 18,000 crores in February. Let's see if hybrid funds will indeed end the year with a bang. Overall, the number, the previous number that we had was over 26,000 crores total equity inflows, expected to remain pretty strong because we'll have the ELS as the year-end tax saving schemes. They will also be mopping up money. So numbers are expected to remain fairly buoyant.
All right, thanks a lot, Surabhi, for that. We'll await that data, and very important to catch the trends. The mutual fund industry has been soaring, so those numbers will be helpful to understand whether that trend continues. Let's shift focus to a CNBC-TV18 exclusive. Earlier today, we caught up with Mark Mobius, the chairman in Mobius Emerging Opportunities Fund. Mark expects major growth potential in the railway sector in India, adds that tech and infra will see increased investments if Prime Minister Modi is re-elected. Listen in.
Yes, and the reason why it hasn't happened as big as it should happen is because the liquidity is not there. In other words, if you look at the size, the market capitalization of the Indian market compared to the Chinese market, it's completely different. China is much larger. So large investors from the US and other parts of the world find it difficult to put their money, too much money, into India. So that's the reason why I say there needs to be an expansion of the Indian equity market. That means more private companies being IPO'd, but also government privatization. And you mentioned infrastructure. I think one area where you can have a lot more size is in the infrastructure area if you do IPOs of various infrastructure projects, whether it be bridges, toll roads, whatever. Of course, the railroads in India is one area that has incredible potential for growth.
Mark, hi, welcome to the show. Well, just focusing a little bit on the near-term theme of elections combined with sectors or themes that you would probably like. Anything specific? You mentioned infrastructure, but would consumption, financials be themes that you would look at as a run-up to elections and maybe even post-elections?
Well, post-election, I think the very interesting area would be hardware, technology hardware. As you know, India is a huge exporter of software. They're doing very good in software. But now there's a need to expand the hardware sector, technology hardware. And of course, as people want to diversify their supply chain away from China, India can take up that slack. You've got the population, you've got the capability, and I believe that's going to be a very interesting area for expansion. And IPOs, by the way.
Right. So, you did speak about a lot of supply or the possibility of a lot of supply in the Indian markets, etc. as well, Mark. I want your thoughts on three things in particular. We usually ask you to make predictions about markets, but if you could give us a sense of what your expectations from the elections are and what post the elections, Modi 3.0, what does that look like to you? And for the PSUs itself, you hoped that there would be some more offerings coming in. What would your thoughts be out here?
Well, one of the things that we're seeing, of course, is Modi becoming stronger politically. In other words, it looks like he's going to have a larger, a stronger position in the political structure of the Indian market. And that is very good news for investors because it means that he's going to continue to push for technology in India and the application of technology. That's number one. Number two, he's going to be pushing more for infrastructure. And that's going to be, of course, we've seen a lot of infrastructure spending, but I think that's going to be becoming much more important and critical for the growth of India. So all of the points are in line. We're in a very good position with Modi getting stronger politically.
You mentioned more supply, right, on the equity side. And that is perhaps one thing which perhaps we've not seen over the last 10 years. I'm talking about disinvestments. Do you think that will also be picked up, in the third term? It could pick up?
Yes. A lot, by the way, a lot depends on the ability of Modi to reduce the amount of bureaucracy for people who want to invest in India. As you know, there's quite a lot of bureaucracy for people wanting to put money into the Indian market. For the large investors, it's easier, but for the smaller investors, not so easy. So I think that's something that Modi will want to work on, reducing the bureaucracy and the paperwork necessary to get into the Indian market.
Are you buying public sector banks or public sector units in general? Because the PSU enterprise crossed that 50 lakh crore in market cap. We've seen a big, relentless rally out there. Where are you on that? Are you buying at current levels? Did you buy earlier? Your thoughts going forward?
Normally, we don't go into the banks, and that's a policy globally, with very few exceptions. We find that banks are subject to a lot of government regulation. And of course, they have problems down the line.
Not just banks, the public sector enterprise in general, all the public sector units.
Yes, we're looking at the public sector very, very closely. We haven't invested yet, but we're looking at it very closely because we believe that's where you can get size if you want to invest.
What kind of themes there in the public sector space?
There, I'm very, very interested in infrastructure. I believe that that would be a very high growth area. The rail sector is very, very interesting. And the airline sector is also interesting.
All right, let's take a quick break on that note. Pritesh Mehta of Yes Securities will be joining in with some trading strategies on the other side. Stay tuned.
Welcome back. The market's doing extremely well now. The Midcap index firmly at a record high as well. But the important part will play out in the second half of trade, which is both the Nifty as well as the Nifty Bank weekly options expiry. Both these indices expire today for the weekly contracts, largely because tomorrow is a trading holiday. That's good news for us. But for those who are writing the options, Nifty is at 22,700 levels, and that has given a lot of confidence to people to write the 22,700 straddle. Now, what is a straddle? It's a call and a put together. You write that at the same strike price. So 22,700 put has a premium of close to 26 rupees. And at the same time, the 22,700 call, if you look at it, the premium is close to around 26, 25, 26 odd rupees. So if you're selling this, you will retain a premium of 50 rupees and you will make the most amount of money if you, see the Nifty playing out in this expiry range of 22,650 to 22,750, which is 50 points on either side of 22,700. And that's exactly what the street has positioned itself for, a range-bound expiry on the Nifty between 22,650 and 22,750. And that's because of the straddles that we've seen written at the 22,700 level. For the Nifty Bank, however, 49,000 seems to be a bit of a resistance and 48,800 is a support. So we're seeing 48,800 puts being written and 49,000 calls being written as well. It's a very stock specific market and a lot of these stocks are in focus. Long positions added on Petronet, LNG, a lot of long positions added, open interest on the upside, and we have a lot of short positions added on Divi's Lab. Now in an otherwise strong market, this is a stock which is underperforming with a near 12-13% jump in open interest. So something's up out there as well. And while the mid caps are a buzz, also keep an eye out on stuff which is likely to go into F&O ban. And in that, two of them stand out. One of them is Balrampur Chini, the other one is Nalco. So watch out for these. We already have 6 stocks in F&O ban. These two may be the latest entrants today.
Okay, thanks a lot for that. Well, chemical stocks are gaining, as we've been telling you for a while. UPL is the one that's really topping the charts right now. 3% higher on that one. But Pritesh Mehta of Yes Securities is joining us on the show. Pritesh, hi, good afternoon. What is the way to approach the market now? It's been a phenomenal rally that we've seen so far. How do you add some more? How do you sort of capitalize on this? And what are the stocks that you can add on to now?
Yeah, good afternoon. So see, when mid-caps, Bank Nifty, everything is around record highs or, are trading higher, it becomes difficult to sit back and do nothing. But I believe for next few days, this is going to be an ideal strategy that traders should be adopting, because I'm not expecting any big moves on the index. See, our customized breadth of Nifty and also Nifty 500, that is, that is reversing of top. So it could lead to some price-wise correction or time-wise correction. So in this kind of environment, be focused on stocks rather than focusing on index, because we are not going to see any big moves coming in.
Okay, what about individual stocks then? You said that be focused more on individual stocks, right? So what are you looking at?
So yes, chemical stocks are buzzing. Our customized chemical index is moving higher. So one stock that we like is GNFC. So basically, we have seen a bullish, anchor column playing out. There was a retracement thereafter. Now double top high is playing out. So move towards 830 is expected. The stop would be around 680. Thereafter, one stock that we don't like from short-term perspective, that is Cipla. In fact, this stock is underperforming pharma index. The stock had marked multiple peaks around the levels of 1500. Thereafter, it has been trending lower. So it is given a double top sell also. The short for a target of 1300, the stock would be around 1480.
All right, so that's about stocks. Do you have any picks in the metals and real estate space?
So see, I think there's a big bull market going to play out in the global commodities market. We saw precious metals doing well. Now the industrial metals are participating. So something like Hindustan, Hind Copper, Hindalco, I think we are going to see big up moves. Yes, Hindalco is ready for 520 levels to 600, but I won't be surprised that there would be continuation trend coming in. So move towards 670 is also possible next few months.
Okay, thanks a lot for that, Pritesh. Have a great day. So those are some stock ideas for you. But earlier today, we spoke to Gautam Dugard, Head of Research Institutional Equities at Motilal Oswal, to discuss his outlook on the market, his top sectoral bets. Listen in to what he had to say.
The first 9 months earnings growth in Nifty was 26%. And we had expected sub 10% kind of a growth in fourth quarter, because we had done the 4-quarter split right at the beginning of April, as we always do last year. So this quarter 6% growth, therefore looks a bit softer. Next year, we are expecting about 14-15% kind of an earnings growth number. I would say, quarterly fluctuations aside, the earnings momentum for corporate India is very solid. And like we mentioned in our report, it almost feels like a mini Goldilocks, because macros are fine, earnings growth is fine. So yes, this quarter is a bit soft because of commodities, but otherwise the trend is quite intact. There is a requirement of 2-3 things to happen. Number one, the monsoon needs to be normal, which is a good thing, because there is a prediction that this year's monsoon is going to be normal. Point number two, inflation needs to come down, which is also happening, by the way. So inflation prints are coming off. And third, it is a hope that the political spending in the forthcoming elections, which at some point of time with a lag of 6-7 months, will propel consumption at the bottom of the pyramid. Hardly 1 or 2 consumer staple companies have been able to compound their top lines at 10%. Most others have compounded at 6-7% top line growth. I'm not even talking about earnings. So top line has been very, very lackluster for almost a decade now. So that's a hope. But from our point of view, we are still very, as far as our model portfolio is concerned, we are completely positioned towards discretionary consumption. There is some element of, as I said, optical illusion built into it. And there is also a fond hope that the global economy will show some recovery, especially China. Because when you talk about metals, obviously the big elephant in the room is always China. So that is our expectation, that there will be some recovery in metals profitability, and which is why we've raised allocation on metals in our model portfolio from being underweight for last almost 9 months to now being neutral.
All right, so increase in metals coming in from the house of Motilal Oswal. Just keep an eye on a couple of these media stocks. Sun TV has been doing well all since morning, and Z Entertainment now comes up on that list as well. It's moved to the high point of trade with a gain of 4%. So Sun TV is at the high point, 5.5% gains. Wonder how much of that has to do with SRH's performance in the IPL. But for now, it is the market which is favouring these media stocks. So we have an up move on both these counters, Sun and Z. Take a short break. Get you more on the markets on the other side.
All right, let's focus on some more buzzing stocks. Vedanta is surging following CLSA's upgrade on the stock. Hormuz gets us the details. Hormuz, over to you.
Very interesting upgrade coming in from Vedanta, from CLSA on Vedanta, and they've upgraded the stock to a buy from its earlier recommendation of an underperform rating, and they believe that Vedanta is well placed to benefit from this ongoing commodity upcycle, considering the diversified business that it has. Now, if you know that Vedanta has its businesses spread across base metals, be it copper, aluminum, zinc, and all of these prices have been rallying in the global markets over the last fortnight or so. And CLSA also says that their efforts to raise capacity and profitability across segments will augur well for the company going forward. And as a result of which, they have raised their EBITDA estimates on Vedanta by 4 to 13% over FY24 to 26, citing higher commodity prices and lower cost of capital going forward as well. Some of the key corporate triggers that CLSA is pointing out that we need to watch out for is the demerger exercise that Vedanta is currently undertaking, where it plans to split the business into 6 different entities. That process is currently ongoing. They said that they'll complete it by December 24. That has not happened yet, but it's still ongoing. And the second one is that the transfer of the Konkola mines from the African to Vedanta itself. That is what the other corporate trigger to watch out for. At current prices, Vedanta is trading at around 5.4 times FY26 EV to EBITDA, which is compared to the historical average of 7 times, which CLSA believes has a potential to re-rate further, because of which they have upgraded the stock to a buy and also raised its price target. It's a 50% jump in its price target to 390 from 260 rupees earlier. So quite a bullish call there from CLSA. An upgrade for Vedanta, 7% higher at a 2-year high as we speak.
2-year high, 7% higher. That's about Vedanta. A lot of these metal stocks doing well. So let's stick with the space itself. We earlier spoke with the management of Shyam Metalics on their outlook and the expansion plans for the company going forward. And this is what they had to say about moving into stainless steel. The raw materials will be given by them, and this will also be a business which would be margin accretive.
If we cumulative this all the plant that we are in stainless steel long product, where in Indore, where we have acquired this metal co-op. So there also we are adding facility for this further processing to increase our EBITDA margin. So this 25,000 ton facility we are adding for bright bars and 18,000 ton per annum for this wires. So if we consider all this, though we are expecting 5,000 to 6,000 CR from this stainless steel. So basically margins, we can say that once this value addition stream start functioning, we will increase this supply chain material by EBITDA margin by 7,000 around 7,000 ton per metric ton, 7,000 rupees per metric ton. Additional EBITDA margin we are expecting. So we are expecting this capital outlay of around 650 to 750 CR for all this.
All right. Well, moving on, Lemon Tree Hotels is in focus. The company has crossed the 10,000 room mark. It also launched its first property in Nepal. We spoke to Patanjali Keswani, the chairman and managing director of the company, to discuss the current demand trends in the hotel sector. Listen in to what he had to say.
Good news is there is no downshift, but we have now entered H1, which is typically the low season for the hotel industry. And when I can compare it to the previous year, I don't see anything which is less than last year. There is, I think, a slight pickup in demand. But overall, as I think I've said earlier, there is, I think, going to be a structural shift in demand in India for branded hotel rooms, and elements of that I think we already see playing out, and this will continue for the next 3 to 5 years, in my opinion. You look 15 years ago or 16 years ago to, say, Indonesia, and a year or two before that to China, and then go back to other countries that were roughly at this point of GDP per capita, as is in India, there is a magic number. The magic number was $7,000 per capita, which means roughly $35,000 per household. At that point, there was a huge change in demand for branded hotel rooms.
That's about branded hotel rooms doing extremely well. The hotel sector being in a bit of an inflection point as compared to where we were, a couple of years ago. Right now, India is where exactly China and Indonesia were in the early part of this millennium. But Kolte Patil, not one day has it been where we haven't spoken about the real estate space. Today, we have that stock moving to the high point of trade, up almost 9% in double digits. Motilal Oswal has initiated coverage. Sonal joins in to tell us more. Sonal.
Well, it's been a week for real estate stocks, no doubt about that. Today, it's Kolte Patil. Motilal Oswal has initiated coverage on the stock with a buy rating. They say that there are number of growth levers which are in place for the stock to grow from here on. It is a leading real estate developer in Pune and expanding in the regions of MMR, that is Mumbai Metropolitan Region, and Bengaluru as well, which is the high growth market. They have 43 million square feet of pipeline in various stages of development. In the last 2 financial years, that is FY21 to FY23, the growth in terms of pre-sales was at 36%. And going forward, considering the pipeline that they have in place on a high base, they will be able to see a growth of 25% in the medium term. The future growth will be underpinned by profitability and cash flows. So even their cash flows are expected to be strong, considering the collections from the already existing projects and the newer projects as well. The targeted project additions over the next 6 to 9 months, because there's a strong pipeline, would enable a 30 to 35% growth according to Motilal Oswal. They have a target price of 700 rupees per share on the stock with a buy rating.
All right, thanks a lot for that. Big mover today, 10% higher. MCX is the other stock gaining in trade after Motilal Oswal upgraded the stock to a buy. Vamakshi joins in now with details from that note. Vamakshi, over to you.
Well, absolutely. MCX is another high flyer in trade today. Motilal Oswal says that the company's new products and the variations that it is making in the existing ones are expected to be some of the key drivers for the company. They launched steel TMT bar contracts, and they see this specific contract to be a large volume originator over the medium term. They've also applied for power future contracts, which are currently unavailable in the market now, and they see a huge scope for growth out here as well. They also plan to launch mini contracts on some of the other metal products, and this in turn can boost the volumes in their futures segment. Regulatory measures like interoperability of margins, rectification of difference in calculation of margins between equity and commodity markets, if implemented, will be important for the company as far as the scale-up is concerned, especially in terms of volumes. Retail participation is another factor. It has significant headroom for growth, and Motilal Oswal says that because MCX currently has only 1.4 million UCCs, that is unique customer codes, as compared to nearly 40 million active NSE users. Now, over the last few years, we also saw that the company was transitioning its core operating software from 63 Moons to TCS, which in turn hampered the launch of some of its new products. However, after the successful completion of this transition, Motilal Oswal has noted that the volumes have also seen a significant jump up. So overall, given all of these factors, they're expecting 47% CAGR in option volumes over the next 2 years, which in turn will lead to a revenue CAGR of 28%, EBITDA 205%, and net profit of 157% CAGR from FY24 to 26. So given all of these factors, we have Motilal Oswal upgrading the stock from neutral to buy. They've given a target price of 4,300 rupees per share.
All right, Vamakshi, thanks a lot for that. So that's about MCX. And given the sort of run that we've seen in a lot of these commodities itself, maybe the exchange would tend to benefit as well. Before we slip into a short break, just pull up the intraday chart of the Nifty IT index. And that's largely because it's waken up a little after a bit of an early morning, snooze that we saw on the IT index at the high point of trade, giving it, wings are Infosys, that's moved higher. TCS, which reports its numbers later in this week, has done well. Tech Mahindra too has moved to the high point of trade. So let's keep an eye out on this pack, largely because of the weight that it commands on the Nifty. If this continues to rally as we move into the results season, then maybe we could see a further uptick on the frontline index itself. Time for that break. As we do that, again, the announcement that we have to share with all of you all, launching CNBC-TV18's first ever live personal finance webinar, CNBC-TV18 Accelerate, with Sonia Shenoy. She'll be joined by 3 well-known experts on Saturday, 11th May, 9 a.m. onwards. We'll be diving into everything you need to know to master your finances, learn how to grow, be it your wealth, insurance, tax saving, managing your portfolio, retirement planning. Lots to learn, lots to do at all ages. This live webinar is for you. There are limited seats, so don't miss this chance. Register now. There's a QR code on your screens. You can scan that or log on to CNBC-TV18.com. We hope to see you on the 11th of May. Welcome back. You're watching us here on Halftime Report. JSW Steel has perked up a little bit. And Divi's Lab, we said there were a lot of short positions being added on that stock. The stock's moved higher. So now if this continues to do well, maybe those short positions will have to cover their positions. And at the same time, we're getting some updates coming in from Tata Motors. The fourth quarter commercial vehicles, Tata Devu sales are down 6% at 1.11 lakh units. We'll get a little more on some more details as well. Passenger vehicle wholesales are up 15% at nearly 1.5 lakh units as well. But let's talk about a quick review of how banks have fared in FY24 as part of our special offering FinStreet. And this is a compilation of all the updates from the financial space that have come in for the fourth quarter and then added to the financial year FY24 itself. And the triggers ahead, we have Abhishek joining in.
Well, in FY23, banks saw record net interest margin, lowest credit costs and best ever return ratios. Records gallored in FY24 for banks with respect to the business momentum, that is deposits and advances growth. Now, deposits crossed the rupees 200 lakh crore mark in this fiscal. Deposit growth in FY24 has been one of the highest that you are seeing in the last 7-8 years or even more. There is no debt to deposits. It's actually the fast pace of loan growth which has meant that the incremental deposit requirement is pretty much on the higher side. Ex of SDFC Limited, deposit growth for the banking sector was 12.9% YOY in FY24, one of the highest that you are seeing in last 8 years. With SDFC Limited numbers, deposit growth has been around 13.5% in FY24 on a YOY basis. That is one of the best in last 10 years. Now, loan growth has been robust as well. Even without SDFC Limited number, growth has been on the healthier side. Loan growth for the banking sector has been one of the highest that you are seeing in last 12 years without SDFC Limited numbers, and 13-year high with respect to the loan growth on a YOY basis even with SDFC Limited numbers. So loan growth for the banking sector was at 20.1% YOY with SDFC Limited numbers. This is the best that you are seeing after 21.55% YOY record that you saw for the banking sector in FY11. Ex of SDFC Limited, the loan growth was a 16.24% YOY in FY24. That is the highest that you are seeing after 17.1% YOY growth that the sector recorded in FY12. So credit to deposit ratio of the banking sector touched 80% for the first time ever. Now, credit deposit ratio has been on the higher side as loan growth has been massive in last 2 years. In fact, the last time system deposit growth outpaced the loan growth was for the fortnight ending 8th of April 2022. Even if you exclude SDFC Limited's numbers, the credit to deposit ratio of the sector is the highest that you are seeing in last 12 years. So CD ratio or credit deposit ratio ex of SDFC Limited is at 78.09% in FY24. Now, this is the second highest CD ratio in last 13 years. CD ratio was at 78.1% in FY12. So entire fiscal year, M3 growth has largely been in double digits between 10% to 12.5%. So first time around in 3 years that you are seeing double-digit growth for M3 entire year. Deposit to M3 ratio has been one of the highest in recent times, at least in last 5 to 6 years or even more. So in terms of outlook, credit growth may come down if banks focus more on deposit growth in order to reduce their credit deposit ratio to RBI's requisite levels. Banks say July or August will be litmus test for the banking sector with respect to deposit flows into the system. Deposit growth may continue to come in at elevated cost for the banks till H1 of FY25. Banks say deposit and advances will see double-digit growth in FY25 as well.
All right, thanks a lot, Abhishek, for that. Let's take a quick break. On the other side, Manisha Gupta is joining in with Kishore Narne of Motilal Oswal Commodity Brokers. Stay tuned. All right, it is a very, very good-looking screen. More the mid-cap end of trade is what I'm talking about. The mid-cap index is now up over 1%. The Nifty is flat. It's kind of holding on to its gains, but it's the mid-cap end of trade that's really surging right now. BEL, Zomato, Nalco, Tata Power, Hindustan Zinc are all sitting at fresh highs right now. And then you have a couple of these other names like NTPC sitting at fresh 52-week highs as well. PB Fintech is at a fresh 52-week high. And Interglobe Aviation 2 is up 3.5%, sitting at a fresh high of almost 3,800 now on Interglobe Aviation. Of course, this entire hospitality, travel, tourism space has been booming. We have seen a lot of other names in the hotel industry too that have done pretty well. And when we spoke to the management of Lemon Tree a couple of hours ago, they said that there is a huge demand uptick that we are seeing, especially because of the demographic dividend that India is sitting on with a young population. But let's do one thing. Let us go across to Manisha Gupta now. She joins in. Manisha, what's on your radar today?
Well, a lot of stuff really. As you were rattling away names, I could do that in commodities as well, because we're looking at multi-month highs in various of them. Gold and silver at all-time highs, 14-month highs in case of copper. And then you're looking at zinc, tin, aluminum, iron ore, cocoa, rubber. All of that actually surging on the higher side. To put some sense on what really is brewing in case of commodity markets, Kishore Narne, Head of Commodities and Currencies at Motilal Oswal, now joins us. Kishore, first of all, this run-up that we are seeing in various commodities, how sustainable is that? Let's start with precious metals to begin with.
Good morning, Manisha. I think the issue is that what we are seeing in precious metals is that an anticipated monetary easing in the Western countries, especially US, is driving number one. Number two, there is a uptick in central bank buying, especially China has been procuring gold for quite some time, and that is actually creating the physical demand. And third is that on silver, we've seen that the physical side deficit continues, and probably even 24 also will continue to be in the deficit, whereas some surge in the demand. So both gold and silver as benefiting from the physical side as well as an increased demand on the ETF side, where the investment demand came in. Despite dollar being stronger, we have seen gold, silver becoming stronger in especially last 1 month or so. So that momentum is going to continue, and silver has a lot of catch-up to do, and probably that will continue to perform higher than gold for some time. And overall, there could be a correction if the Fed comes out and says that probably the economy is not ready for a rate cut, as the numbers in US economy are still not showing any weakness. The broader economy still continues to be stronger, which is not giving any scope for a rate cut. So probably today, these prices are pricing in a 2 rate cut policy at this point of time for 2024. If at all reduces, then there'll be a correction in these metals.
Kishore, the whole conversation about that gold is not getting bought. There is no deliverable gold trades happening. It's mostly about speculative trades, money managers, hedge funds. Big non-deliverable trades is what is driving gold on the higher side. Do you see cracks coming in this rally at any point in time at all?
Not immediately, because there is a lot of short covering also happening, because de-hedging is a big trend. So when you look at the positions on the short side which are reducing, it's basically minus de-hedging is a big cause of that actually, because anything above 2100, 2200, it makes it extremely comfortable and not to hedge, and the cost of producing gold still remains close to around $1,200, $1,300. So they're sitting at a massive margin at this point of time, which discourages them from hedging in these markets. And also the second is that forward premium in gold has shrunk so much that there is no point in doing a long-term hedge in these markets, and most of the earlier long-term hedges getting unwound in the market. So that actually is also creating a short covering support for the market. So money managers are the last ones to jump into this rally, and last 3 months have been have seen that some of the money managers and the ETFs actually has driven some demand here in these markets.
All right. Kishore, I was reading your report that silver can hit lakh rupees a kg. How convinced are you on that one? Until what time period? And would you advise buying at these levels? And what is the best way to buy silver?
Timing is a little tricky one. You very well understand that any analyst can really predict a level, but not the time. So if you ask me at what time, what exactly the price would be, that I'll be an astrologer. So rather than that, I'll not get to the timing part. But definitely what we see is $34 on the silver is pretty much achievable at this point of time, which loosely turns out into around 92,000 in India. But silver has a tendency to outperform itself in any scenario, either downside or upside. So we are expecting it to extend this rally to around $36.5, which will take it briefly above $1 lakh, 1 lakh rupees in Indian prices. So I think most positive timing which I can give is probably before August, and if at all a base case scenario towards the end of this year.
All right, I will go with end of this year. August seems too close by for prices to jump from 80 to almost $1 lakh and plus, as you said. But Kishore, a quick word on the other commodities also, because it's not just gold and silver. Metals seem to be having a mind of its own, the way it's turning one way.
I think so. Entire metal market has been super focused on China, and the way China is trying to balance its economic recovery, or trying to prop up the recovery, and we have already seen massive bankruptcies in Chinese property sector, and I think there is the more bad news, the markets actually read a lot of good news in between the lines, because the massive downsurge in real estate market is actually creating an expectation in the markets that something will be done by the Chinese to stop this fall and to encourage the sector. But because the inventory overhang, I don't really see that real estate sector soon turning around. But I think there could be a lot of inventory built up which could happen in metals. There has been a lot of inventory drying up in the markets. So primarily, I bet on two metals. One is zinc and the other is copper. So copper will continue to perform around 900, 950 could be the targets for short to medium term. Zinc is something which is, again, because iron ore is also, and the iron and steel itself is going up. So I think galvanizing demand is really surging up. So zinc can see another 15 to 16% rally from here.
All right, those are big moves anticipated in the markets going forward. We've seen a huge run-up already, multi-month to multi-year highs in many of these commodities, but these are not the levels that you short. These are the levels that you still go long in, is what the experts tell us. Kishore, thank you so much for joining us and sharing that sense and strategies for many of those commodities. With that, it's a wrap on Halftime Report. Business Lunch will take all the action forward.